We will be covering the next unit, which is related to the funding and regulatory aspects, So let me change the file over here so that we could proceed with the third unit from the treasury management, so that we could proceed with it. So kindly please wait for a minute so that we could proceed. So it is related to funding and regulatory aspects. So as per the Reserve Bank of India guidelines, the banks are to maintain the CRR and SLR. I already told you. The banks are to maintain the CRR and SLR, and further CRR is to be maintained as per the Reserve Bank of India Act under section 42 subsection 1, and SLR is to be maintained as per the Banking Regulation Act as per the section 24. And further we will be considering them both. But before, let me tell you that Reserve Bank of India is having the sole authority so as to issue the banknotes. Reserve Bank of India is having the sole authority so as to issue the banknotes denomination from 2 to rupees 10,000 are issued by the Reserve Bank of India, and that is covered under section 22 of the RBI Act. And further, it is also the sole responsibility of the Reserve Bank of India so as to maintain the value of the rupee, so as to maintain the global value of the rupee. So currency is only the cash component of money in circulation. So what is the cash component? Currency is only the cash component of money in the circulation, and that is available in a very small portion. That is available in very small part of the total money. So let me tell you related to the multiplier effect what it is. Let us have a look at it. Now, banks do what? Banks basically, they do have the deposits, and based upon these deposits they do lend the money. So let us take the case that the deposits were worth rupees 100 crore, and out of these banks do lend the money amounting rupees 80 crore rupees. Now out of these 80 crore rupees, the borrowers again will be basically giving money to someone. Let us take the case that someone has purchased the machinery, someone has purchased the plant, someone has purchased the building. In that particular case, the person who has again the deposits, they will be again depositing these amounts with the bank itself. So let me tell you that out of these 80 crore rupees, let us take the case that rupees 50 crores were again deposited into the banks. Rupees 50 crores were again deposited into the banks. Now the banks are having rupees 150 crore in total, and definitely the banks will be lending more out of these. And ultimately it will lead to what? It will lead to the leverage. And that is what is called as the multiplier effect. Okay, now so as to basically keep this multiplier effect into a limit, because this is a risk itself. So when there is a excessive credit growth in the economy itself, that is an inherent risk itself. That's itself a risk. So if there is a excessive growth of the credit in the market, definitely that's a risk itself in the market, and further that is to be limited, and that can be limited by way of limiting the surpluses or liquidity in the market itself. So Reserve Bank of India use both CRR, SLR and other monetary policy tools so as to basically absorb the liquidity from the market, and whenever it is required so as to expand the market, the Reserve Bank of India uses these particular tools so as to expand the market too, so as to provide the liquidity in the market too. Okay, now let us have a look at the function that money in the circulation is indicated by the broad money. So money in the circulation is indicated by what? It is indicated by the broad money. And as I already told you that Reserve Bank of India is having the monetary policy so as to control the rate of inflation. So if there is excessive amount of liquidation available in the market, that will basically lead to what? That will basically lead to lesser demand. If we say the supply is greater than that of the demand, in that particular case, what will happen? In that particular case, the interest rates will go down, and further people will be basically demanding more money, they will be spending more, and ultimately what will happen? The inflation will rise. The inflation will be rising, and further, so as to ensure the economic stability and the financial market stability, and so as to control the rate of inflation. So as to control the rate of inflation, the RBI basically is having the monetary policy with it. And so as to achieve these objectives, Reserve Bank of India is to exercise the full control over the money supply. Reserve Bank of India is to basically exercise the full control over the money supply, and Reserve Bank of India is basically money impounded by the Reserve Bank of India by way of cash reserve ratio. So basically we can say that by the way of cash reserve ratio and by way of SLR, Reserve Bank of India constricts the bank. It basically constricts the bank so as to basically reduce the multiplier effect. So it is basically a guideline by the Reserve Bank of India which says that you have to maintain, let us take the case the CRR as, let us take the case the CRR as the CRR as what, let us take the case the CRR as what, CRR as we are just assuming the CRR to be 4%, let us take the case, and further let us assume the SLR at 18%. So we are assuming CRR at 4% and we are assuming SLR at 14%, and also the banks are to allocate the capital for the risk weight assets, and also the banks are to allocate the capital for the risk weight assets, for the market risk, operational risk, and further for the other types of the risks over there, operational risk, market risk, and the credit risk. Is that clear? Now let us take the case that banks are having 100 crores of the deposits. Banks are having 100 crores of the deposits, and out of these let us take the case that banks are able to lend 70% part only on max. Let us take the case the banks are able to lend only 70% of the part. But let us consider the case when SLR is now increased. Let us say the case SLR is increased to 22%, and in that particular case the banks will be having the lesser funds. The banks will be having the lesser funds for the credit purposes. The banks will be having the lesser funds with them for the lending purposes, and ultimately that will reduce the multiplier effect. That will be reducing the multiplier effect. Is that clear? Okay. Next, it is related to what? It is related to Reserve Bank of India. Reserve assets prefer to what? The cash deposited by the scheduled commercial banks by the Reserve Bank of India must comply with the CRR and SLR requirements. So there are CRR requirements we are having the SLR requirements which are to be fulfilled. CRR is a component which is to be maintained in the form of the cash, and SLR is the component which is to be maintained in the form of cash, gold, and further the approved government securities. First of all, it is related to CRR, that is a cash reserve ratio. First of all, it is related to the cash reserve ratio. So CRR refers to the cash reserve that is to be maintained by all the scheduled banks. So all the scheduled banks are to maintain a fixed percentage of their net demand time liabilities. All the scheduled banks are to maintain a fixed percentage of the net demand time liabilities as per the section 42 of the Reserve Bank of India, and further this is to be maintained with the Reserve Bank of India, and further this particular ratio is to be maintained. This particular ratio is to be maintained by the banks so as to ensure the liquidity and so as to ensure the solvency of the banks. So as to ensure the liquidity and further so as to ensure the solvency of the banks. And this particular ratio is to be maintained at fortnightly average ratio. This is to be maintained on 14 days average base ratio, and further this is to be maintained from Saturday to following Friday. From Saturday to following Friday. On the daily basis, it is to be maintained at 90% average balance. It is to be maintained at 90% average balance on daily basis, but on fortnightly basis, it is to be maintained at par. It is to be maintained at par, and whatsoever the balances are deposited by the banks with the Reserve Bank of India, no interest will be paid by the Reserve Bank of India, and further there is no upper limit, and further there is basically no floor limit and ceiling limit in case of the CRR, and further in case of the non-scheduled commercial banks. So as I told you, the scheduled commercial banks are to maintain the CRR as per section 42. But what about the non-scheduled commercial banks? Non-scheduled commercial banks are also to maintain the CRR, but this is to be maintained as per the section 18 of the Banking Regulation Act at 3% of the net demand time liabilities. At 3% of the net demand time liabilities, the non-scheduled commercial banks are also to maintain the CRR, that is a cash reserve ratio, as per the section 18 of the Banking Regulation Act. Now let us look at the term NDTL. Let us have a look at the term NDTL. Now this basically includes two components. One, it is a demand liabilities, and other one it is the term liabilities. Whenever we talk about the demand liability means when we talk about the liabilities, these are basically related to the deposits with the banks. This is basically related to the deposits with the bank. And when we say demand liabilities, what does it mean? It indicates the deposits which can be basically withdrawn on demand, which are basically withdrawable by demand. Okay, so this basically relates with the CASA, that is a current account deposits, or saving fund account deposits, or basically we can say whatsoever the margins have been maintained for the LC or guarantee purposes, or whatsoever overdue term deposits, even the overdue term deposits which have not been renewed, and have not been picked up, those are also available on demand. So let us take the case that your FDR was going to, let us take the case your FDR is basically going to matured on 1st of November. Now you have not basically renewed this particular FDR. In that particular case, you can withdraw this particular amount of FDR, whether it was related to term deposit, but now you can basically withdraw this particular amount on demand. Okay, so that is also covered under demand liabilities. And also when we talk about the money transfers or demand deposits or related to unclaimed deposits, all are basically covered under the demand liabilities. And also if there is a credit balance under the CC limit, I'm not talking about the unutilized limit part, I'm talking about the amount which is over and above the amount sanctioned. Okay, so if you're having over and above the amount sanctioned in the CC limit, that is also withdrawable on demand. And also if you have deposited any amount as a security, if you have any amount on securities which is payable on demand, that will be also covered under the demand liabilities. So all these are covered under the demand liabilities. FDR is not a demand liability. FDR is not a demand liability, whether there is a embedded option available that you can take a premature payment, but those are not covered under the demand liabilities. Those are covered under the term liabilities. Only and only the case of the overdue term deposits we are taking as a demand liabilities. Okay, next it is related to the time liabilities. So whenever we are talking about the bill payable, unpaid dividends, sundry account balances, when we are talking about the term deposits, that is related to fixed deposits, cash certificates, margin on LC which is not payable on demand, or which are whatever deposits you are holding which is not payable on demand, whatsoever the deposits are being held which are not payable on demand, or staff security if any there is, those are also basically related to the time liabilities. Other than that, there are other demand and time liabilities. Like bills payable, which is to be paid after some particular time. So if you have drawn any bill and further that is to be paid after some particular time, that is also your time liability. Otherwise it is also unpaid dividend. So amount which is to be paid to the shareholders. So amount which is to be paid to the shareholders but yet not paid, that is also a type of other demand and time liability. Other than that, maybe we may be having the sundry account balances. So as to if there was difference in trial balance and further those are placed under the sundry accounts, that is also related to other demand and time liabilities. Okay, so these are the components related to time and demand and time liabilities. So these are the components related to demand liabilities and the time liabilities. Further, it is related to the liabilities for this purpose does not include. So liabilities for this purpose does not include the paid up capital. So the paid up capital is not part of the time liability. These liabilities are not covered under this particular part. So if you're having this, if you're having the reserves, if you're having the paid up capital, those are basically not forming the part of the these particular liabilities under the net demand and liabilities. So these liabilities will not be forming the part of the liabilities such as the paid up capital or the reserves. And also if there is credit balance in the profit and loss account, that will also be not be forming the part of the liabilities. Okay. Other than that, if you have borrowed any of the amounts from the Reserve Bank of India or from the IDBI or any of the NABARD or any of the institutions, that are also excluded. Those are also excluded. And also, if there is any amount that you have received from ECGC by invoking the guarantee, or DICGC claims are pending, and further, if there is any amount received from the court receiver, those are also not forming the part of the liabilities. These are not covered under the liabilities. Let me tell you again that this question was particularly asked last time. Particularly in the last attempt, this question was asked related to it, where it was clearly asked that if the paid up capital or reserves can form a part of the NDTL or not. Okay, so this type of questions can be asked. So you need to keep this particular thing in mind, that paid up capital, reserves, and any of the credit balances of the profit and loss account will not be forming the part of the liabilities. Other than that, if the amount is borrowed from the Reserve Bank of India, from the SIDB, from the IDBI, from the NABARD, or any of the department, that are also excluded. That is also excluded. And also, if there is any amount received from the ECGC by way of invoking a guarantee, if there is any DICGC pending adjustment, if there is any amount received from the court receiver, that is also excluded. Okay,